All right, welcome back, everybody. This is the No Money Real Estate Podcast, and on the show today, we're going to be deep diving with my buddy Dan Char. He's a crazy mortgage broker. He's got tons of money, and he knows what the hell he's doing, and we're going to be doing a deep dive on financing deals. We'll be back in a minute. Hey, my name's Ken Dunn, and I'm a real estate investor. I want to welcome you to the No Money Real Estate Podcast. On this show, I'm going to interview elite-level real estate investors from all over North America, and I'm going to help you to see one thing that all successful real estate investors have in common. They built their portfolios without using a dime of their own money. I've got a portfolio of $300 million in real estate. That includes resorts, apartment buildings, commercial buildings, and I built the entire portfolio without using a dime of my own money. Real estate is a business that anybody can get into, but the strategies that those titan real estate investors use to build massive portfolios have been kept secret for decades. Now, because of this show, I'm going to reveal them to you. So let's get started. All right, here we are. Dan Char's in the studio. How are you, brother?
Good to see you. How you doing? Nice seeing you, Ken.
Listen, we're going to spend some time today talking about funding deals. And I know right up front, you've funded a ton of deals for me. A bunch of mortgages. We've done a lot of stuff in our businesses together. And I want to just really see if we can go deep into the nuances of doing mortgage deals.
Absolutely.
Let's start off with, tell everybody a little bit about you and your background and your business and what you're doing.
Yeah, for sure. I've been in the finance industry now. I'm hitting 18 years next week. I started out working at Scotiabank. I started off as a teller, and then I moved my way up to a senior financial advisor. Been there for 8 years, and then when I was 26 years old, I became an independent mortgage agent. And here we are now. I'm a mortgage broker. I was hitting 10 years now, and it's been a fun journey.
And you're an investor.
I'm an investor.
I got to get you to tell me. I got to get you to talk a little bit about your first property. You're the only guy I've ever met that's actually bought a property with a credit card as a kid.
Yeah.
So tell everybody how that happened, what that's all about.
So very funny story. I was working at the bank. I had a safe, secure job. I was making $40,000 salary, and then I left my position, and now I'm independent. I have no big company backing me. I have no savings because I'm a big spender.
Yep.
I had no income because I had no clients. And my buddy, who's a realtor, comes up to me and says, Daniel, you got to buy this property. And if you buy this pre-construction property, you're going to make a lot of money. And it's $300,000. So me and my partner said, how are we going to buy this property when we have no savings, we have no income? But it looks like it's a good deal because it's $300,000 and we see what's happening in the marketplace. Like there's the Green Belt Act. You can't build anymore. There's a lot of immigration. And it's like, this looks like the right decision. And I said, you know what? I have a credit card. Why don't we just cash advance my credit card at 23% interest?
Oh, man.
And that's what we did. So the builder needed only about I think it was like a $6,000 deposit. So I cashed advance at 23% interest.
$6,000.
And now with $6,000, none of my own money, I held a $300,000 contract in real estate. And
so you didn't have to put any other money in it?
I didn't have to have my own savings. I didn't need a mortgage because it was just based off a contract. So I just cashed advance at
Did you end up closing on the condo? Or
yes, I did.
You flipped the paper?
No. I eventually, so the trick was everybody asked me, how did I do it at 23% interest? I didn't plan on carrying the debt for 23%.
Yeah, for sure.
Right? So I went back to my bank and I said, well, I have a $20,000 credit card limit. I don't need a $20,000 credit card. Can we split my limit into part line of credit at 7% and part credit card at whatever it is? And they said, no problem. So I took my new limit of a line of credit at 7% and I paid off the credit card.
So now you have the $6,000 at 7%.
At 7%, yes. And so now I'm paying the builder every few months. And because it was a pre-construction, I didn't even need a mortgage. But eventually, once it was built, I got a mortgage. So now I didn't have to put any money down. And then I lived in it.
Okay, so for that place, did you take advantage? Was there lift because of the time?
Oh, yeah, for sure. For sure.
So when you actually finally moved into it, what was it worth?
So we lived in it for about 18 months and then we sold it for $500,000. So I bought it, so $200,000.
All right.
Yeah.
Fantastic.
Yeah.
All right, let's switch gears now and let's talk about raising money. Let's talk about deals. You spend a lot of time with me, so you know I'm a big proponent of 100% financing. And the way I like to structure deals is get a first mortgage from Dan, 60, 70%, whatever we can arrange from the lenders, and then I'll raise the rest of the money from second lenders to close, and I'll raise all my construction money. But there's a lot of stuff that goes into that. So I almost feel like I want you to make this very basic right now and talk about the different ways to get a first mortgage. Like, what are the different options? First, second, like, A, B, private.
Right.
Just
everybody.
the whole thing.
So there's 3 channels of financing. There's A, there's B, and there's C. And 99% of the population knows the A financing. That's your local bank, your local credit union. And they're great. But what they look at is what I call the finance triangle. They're looking at, think of a triangle. They're looking at the income, the credit, and the down payment. And if something is not to their liking, your income is off, or your credit is off, or the source of your down payment is off, then they're just going to say no.
They don't tell you why. They just say no.
They'll just say, we can't fund this deal. So, but then there's another tier, which is the B lending alternative tier, which is very great for self-employed individuals, business owners, people who make good money, but when it comes to tax season, they have a lot of write-offs and they get turned down from banks all the time.
So this is like a home trust or something.
Right, exactly. And they can take bruised credit, they can take business income, and that's how we get qualified on deals. My personal deals are through the alternative side. And then the secret weapon, and that's what you're talking about, the secret weapon of raising money and building wealth is the private money. That's a C channel financing, where they don't look at any income, they don't care about your credit, and how they look at their deal is through the deal itself.
Right.
They analyze the deal. And so for the average person, when they hear that, I could get financing with no income, no credit. First thing that they think of is, that sounds too good to be true. That's a scam.
Yeah,
right?
Totally.
Right? Because it does sound like that when it's like, because my local bank wants this, right?
Because their parents told them they can only get a mortgage through a bank.
Right, exactly. So on the C channel, they're looking at the property. So they want to look, where's the location of the property? What type of property are you buying? Is it a condo, a townhouse, a detached home? What is the condition of the property? What is the purpose of the property? What is the marketability of the property? And what are you going to do with this? Are you going to live in it? Are you going to flip it? So all of those are the parameters that private lenders look at.
Because the private side of money, and there's levels in private money too, right?
Of course.
Because there's institutional mix mortgage investment corporations that you can borrow money from, right through to Johnny Rich guy down the street.
Absolutely.
The other thing I think would be really important to like assign some numbers to is the understanding that depending on where you go for the first mortgage, it dictates what your interest rate is going to be. So the cheapest interest rates are the hardest to get, the hardest to qualify for, the A banks.
Correct.
And as you go down the road, you're actually going up the hill.
Absolutely. So
what are we looking at like in B and C? What are some rate ideas?
So right now in 2023, in October, even your typical A financial institutions, you're going to be over 7% with income qualified mortgages. So you have to qualify according to the rate and the government rules. And that's the kicker. And the government rules we're talking about is a stress test. So whatever the rate you're going to get, you have to add 2% on top. So if you're getting a 7.25 rate, your income needs to qualify at 9.25. So that's the A side. And then the B side is just a little bit higher.
So like what, like 8, 9%? 10%?
Around there. It could be around 8. Yeah.
And then the private lenders is where it gets crazy.
Private lenders, you're looking at double digits for sure. You're looking at 10%, 12% plus fees on top.
But it really depends on where you get it though, because you could go to like one of my favorite private mix. You could go to them and they're going to be like 9%,
correct,
10%.
Correct.
But then you have private lenders that will basically just do the deal based on the loan to value of the deal.
That's it.
And they're at 15% or 16%.
So I have lenders that are around between 12 to 14 to 15, but they're very, like, they're not very restrictive.
They're flexible.
They're very flexible, right? And we allow a lot, right? But we do a lot of due diligence underwriting. And that's where the lender's package or the investor's package comes into play,
It
because
helps.
it doesn't mean that we're just lending anybody money. We still have our criteria, but as long as the deal fits in that criteria, we will lend money on that.
But isn't the criteria really will the property be able to sold if shit hits the fan? Like that's really what they're looking for, right?
Yes.
Because they're getting 15% and it's normally interest only.
Correct.
But if something goes wrong and that borrower doesn't pay, they're going to have to seize the property and sell it. So they just want to know it's going to be easy to sell.
Yes, that's it. So they want a property that it's in a good market. So it's in a stable market or it's in an increasing market. And they want to make sure that the client has enough skin in the game, or if they're doing a no money down, they can show what the end result's going to be.
That after repair value.
Exactly.
So all that stuff's really important. The other thing I was just thinking of as we were talking though, is the fact that when you get into that private money, you're doing interest only payments. So there is, like if you're doing a 7% Royal Bank mortgage, you're going to be paying principal and interest.
That's correct.
So like on a $500,000 mortgage, you're going to pay $3,000 or $4,000.
Correct.
You could take that same $500,000 from a private lender and probably not actually paying much more because it's an interest only payment.
Interest only. So your rate is a little higher, but you're only paying interest. And it doesn't make sense to pay principal and interest when you're paying double digits anyways. There are private lenders that have that option. I recommend not paying principal and interest.
Right.
Take that extra money and just put it to your project, or pay your tax, pay your utilities, whatever it is. So just pay interest only if you're in private funding.
The other thing that I think is important for real estate investors to understand is if you want to do the deal your way, you're going to pay. Like if you want to do the deal at 100% other people's money, you're going to pay more. You're going to, it's more of a burden on you. And if you look at that continuum you just talked about, if somebody's doing, I'm going to use 500,000. So somebody gets a first mortgage from a broker for 300,000, and then they get a second mortgage from other sources to take it up to 100%.
Correct. Yeah.
There's only one type of first mortgage lender that's going to be willing to let a deal go up to 100%.
That's correct. Only private lenders will do that. So if you try to walk into your bank and get a regular mortgage, on the contract is going to say no secondary financing. So they want to know where your down payment's coming from, how much the down payment is yours. And if you're borrowing money, they want to calculate that into your debt to income ratio.
Right.
So a lot of times people will say, well, Daniel, I want to buy my second home or buy a rental property. And I ask them, where's the down payment coming from? And they say, it's from my HELOC. Okay, great. It's coming from your HELOC. We have to add the HELOC debt.
The cost
of that to the next property. But if we do private funding, we don't add that cost at all. Now we're looking at the deal itself. And on the private mortgage side, we will allow a second mortgage up to 100%. We will even actually go past that.
Think about it this way. If you're going into an A bank, they're going to be the most risk adverse. Like they're going to be nervous. They want to know that if you don't make the payments, they can sell it quickly. And they're going to sell it at a discount. So they're not going to let you finance up to 100% because they want that buffer to drop the price and sell it quick. Now, as you get more open, you either go with the lowest rate, get the best deal, or you go with the most flexibility.
Right.
The more flexible you want the lender to be, the more you're going to pay, the harder it's going to be in terms of money goes.
That's correct. And this is what I tell a lot of my clients. When it comes to mortgage financing, price is not everything, because the most common question I get is, what's the rate? What's the lowest rate?
Yeah. You gotta hate the shoppers.
And it's not even like, I always tell them, a mortgage has so many components, right? You have the rate, you have the term, you have, is it an open? Is it a close? Is it a variable? What's the prepayment privileges? There's so many components into a mortgage that it has to fit for you. It has to be suitable for you. And the way I can best relate it is when you call your realtor and say, I want to buy a property, you don't go to your realtor and say, I want the cheapest house, because they're going to, you know what they're going to show you, right?
Yep.
But what you say is, I want to raise my family in a nice, safe neighborhood. I want to be right beside a very prestigious school, right beside a highway. And I want a 2-car garage, big front yard, big backyard. And based on those criterias, in today's market, that's a $1 million house, right? Yep. So we never spoke about the price when we're looking at our dream home. But when it comes to the financing, to get it to come to reality, we always talk about pricing. And I want to always shift it to, it's not all about pricing, it's the flexibility on how to get into the market.
Without a doubt. Let's talk about investing.
Yeah.
When I look at a deal, I won't buy a deal unless I know I'm buying something that's undervalued, that I'm buying for less than what it would sell for if it was a listed property. And then I'm only going to buy that property if I can see when I'm looking at it that I can increase the value significantly. So if I buy a property for 400 grand, I'm not going to buy it unless I know I'm going to increase it to 800 grand.
Yeah.
So my first private mortgage and the second one up to 100%, part of the reason they're willing to lend me the money is I'm going to show them comparables and prove to them that it's going to be worth 800 grand.
Absolutely. That is very key.
Are there any other things that when private lenders are looking at deals and they're looking at, because they're looking at two things. They're looking at the property and they're looking at the person. Is that property worth what I'm lending?
Yes.
And is that person that's asking, does he have the ability to do what he says he's going to do?
That is very key. I'm glad you brought that up. The person, yes, they don't look at the person fully because they're basing all their criteria on the property. But yes, you're right. If somebody has credibility, like they have a portfolio of doing flips, that makes a big difference. If they still look at your credit bureau, because when it comes to private lending, they don't discriminate on bad credit. What they'll do is they'll take bad credit and price it differently. So for someone who has an 800 credit score, they might get premium pricing. They'll probably get a 10% rate, an 11% rate in today's standards. Where someone who's got a 500 credit score, the private lender is not going to say, we're not going to lend to you, but because your credit score is not that great, we have to charge a premium. And now you're going to pay 13, 14, 15, right? So that's what we have to see on basically it's the property and also the client.
When you're seeing all these people that are trying to do 100% financing, what happens if they don't disclose it? So this is something I've heard recently that some people have done, and I think they're setting themselves up for a shit show if they do this. But I've seen people that will try and go out and get B lending, like a home trust or somebody else, and they'll try and pull a fast one where they'll borrow the money up to 100%, but they'll convince their friend who's lending the money not to register for a couple of days after.
I wouldn't do any of that. Like,
what happens to somebody if they get caught?
That's just fraud. So like if you're serious about building a portfolio, your documents have to be clean. You have to be, because you're going to a lender who's going to be a business partner. This is how I always sell it to my clients. Your lender is your business partner, and it's not a one and done. And if they ever find out, then you're blacklisted. And it's a small community because everybody talks, right? And if you're planning to build a portfolio and you get burned from one lender, you're going to get burned from another. So it makes more sense to just be truthful and tell what your intentions are and get the right financing up front and build your portfolio that way.
Right.
Yeah. So I rather pay 2% or 3% more and not burn any of my lenders.
Yeah.
Right. Because now anytime I pick up the phone, I have $2-3 million waiting for me versus I'm walking over eggshells, hoping that they're not going to find out what I did on the last deal. Right.
Yep.
So.
Well, friends, there you have it right there. That little bit of conversation we just had should prove to you that the guy knows what he's talking about. He does all my first mortgages. And so if you're looking for somebody to help you do a deal, I'll put his information to contact him in the notes of the show. Any final words from you, Dan? Anything you want to share with these guys?
I like to always say the cost of financing comes from your profits, not your pockets. If you do your deal correctly, if you analyze your deal correctly, don't get scared of the payments. Don't get scared of the fees, because when you're buying real estate, there are going to be fees. You're going to have land transfer tax. You're going to have lawyer fees, appraisal. It's just part of the game. But if you do your deal analysis correctly, it all comes from the profitability of your deal.
Hey, if you like the show today, don't forget, you got to give us one of those 5-star reviews on the podcast channel that you're on right now and tell us something nice about it. If you're on YouTube, subscribe to the damn channel. If you like this stuff or you have questions for Dan or I, put some questions in the notes. I'll check it personally and we'll see you on the next show.